It's all adjusted up here. Okay, so far this week, it is the last couple days of September. So September 30th, we're sitting on right now. And October starts tomorrow. Pending home sales, what we had yesterday, and is actually quite a bit higher than what it was anticipated. Um, and it's quite a bit higher than what it was from the previous reading. Now, why would that be? What has the news been screaming, just like yelling practically? Rates have gone down. People freaking out about how far the rates went down, but it was all noise. They went down, but not a ton, right? It made it seem like overnight the Fed did everything that possible to drop these rates. Fed dropped the rate, but it didn't do a whole hell of a lot to our interest rates. Actually, it jumped them up, like we showed you. We also have the FHA Housing Price Index, which actually had a bit of its decline from previous reading. So prices haven't really done a whole hell of a lot, comparatively speaking, even though pending home sales has gone up from what I can see here, right? Then we got the home price index, the Case-Shiller home price index, not as high as what they forecasted, but it still went up. Still a little bit of an improvement there. Chicago PMI, a little bit of a decline from where they anticipated. Consumer confidence actually down from where they're expecting it to be. And then we've got the job openings, the JOLTS job report, showing that we're pretty close to in line, a little bit higher than what their anticipation was. So come up tomorrow, we're going to have mortgage applications, ADP. That's going to give us, so the ADP reading is kind of like an employment reading. ADP is going to say what their payroll numbers show like with the checks that they cut, right? ADP is the payroll company. And then you're going to have construction spending, manufacturing index. Then we're going to have initial claims on the 2nd, which is interesting. Sometimes when you get further into the week, you get the jobless claims, you get the non-farm payrolls on the 3rd. You start to see that sometimes there's a difference, a significant difference between what ADP says, the guy's cutting the checks, and what the reading comes out from the Bureau of Labor Statistics, which we know has been cooked in the past. So we're going to see how that all plays out. But something I thought was very, very, very interesting. I was listening to what was being said today on the Macro Watch, Richard Duncan. Now, hopefully it's okay if I show you this stuff. These are charts that are actually out in the wild through the St. Louis Fed, even though I pulled it from Richard Duncan's website. So hopefully, Richard, appreciate you, brother. Thank you for putting that out there. Hopefully this doesn't get me in any trouble with you, but he's a good dude. We've done a podcast together. I can go check it out. The Passive Real Estate Investing podcast host was Melissa Nash, and we actually interviewed with Richard together. It was a great conversation. Well, he talked here, if you go all the way back to quantitative tightening when that started, which is right here in 2022, and they really started getting into the opposite direction of where they were going out with their quantitative easing. So all the easing was going on before that, heavy easing, right around 2019 and 2020. Again, right here, this massive, massive easing. Look at all that money got pumped in. That was during COVID, right? And we had more money getting pumped into it, just dropping those interest rates till they stopped at the end of 2021. By the time you achieved May of 2022, we start to see it really, really going heavy into the tightening. But look, they've eased off of their tightening, right? They're not tightening as much, which is very, very interesting to consider. So then we look here to the quantitative easing. Look back pre-2008. How well was the Fed? Look at I'm looking at the orange line here. The orange line represents mortgage-backed securities. How much was the Fed in MBS? Nothing. They were not in MBS at all. They weren't buying mortgage-backed securities. They weren't affecting the interest rate. Then in 2009, which I've showed you over and over and over and over again, when they jumped into the end of 2008 and into early 2009, they pumped and pumped and pumped and pumped. Then you get to 2020 where they heavily pumped. Look at that. They pumped like crazy, and then they backed off end of 2021. And they have only slowly backed off. They still haven't even achieved getting below the level where they were during the low interest rates during the pandemic, or actually pre-pandemic. Look at that. Pre-pandemic, look at how much from 2014 to 2018. Those were interest rates in the I guess probably in the 3s and 4s for people buying houses to live in. They were in the high 4s, low mid 5s for people that were buying investment properties. Look, we are even low as they were back then. That's very, very interesting to take and keep that in your mind, right? If the Fed still has that much money in quantitative, and they backed off their quantitative tightening a little bit, as you saw on the previous chart, they're not not heavily tightening as much as they were. What does that mean for our interest rates? What does that tell you? Now let's go back and look at our charts, which we spent a lot of time on, right? Look at these charts. Okay. Here is our mortgage-backed securities chart. If you start laying those over this, start seeing the history on this thing, they start doing the quantitative tightening, all that, we start seeing that massive spike of where the Fed was dumping money into it. That massive spike was right here. This is where the Fed dumped that monster spike. Let me move this down so we can see it better and with the dates. This is that monster spike in March of 20. Where they shoved a ton of money and they kept pouring capital into it, kept pouring in till you get to the end of 2021, they start backing off. You get into 22, they really start backing off. Get into May of 22 and look, May of 22 is when we see massive declines and they're hitting this level. What is that level again? That level is when they started quantitative easing. Then they blew below that level. And we have not been able to get above the point where the day they announced quantitative easing. Why is this important to even think about when we start looking at the previous charts we just talked about and what we have today? That means where we are right now still has Fed money in it. The Federal Reserve still has capital in here. Prior to that, the Federal Reserve was not affecting the interest rates. Well, if this was strictly all on the market, our rates would be a hell of a lot higher. We'd be seeing our interest rates at probably 8-9% is what I would guess. When you're talking about people, houses to live in. So if you, as a real estate investor, are right now waiting for the rates to go down, guys, they are already pumping money into it. They're already backing off what they've been doing. We may see some come in. It's possible. They may do quantitative easing or a little bit more easing, may back off of tightening altogether. If they back off tightening altogether, we can see the rates come down. So let's go back and take a look here. Now, if the rates come down, what does that mean for you? You need to sit here and think about this for a second. If you're like, oh, Aaron just said they may do this. Well, it's possible. Richard's talking about it. You need to go to macrowatch.com and subscribe. He charges $500 a year. It's great. If they do this and they start pumping money in, look, they pumped a ton of it in 2009. They kept kind of fluctuating it in, filtering it in, dumped a ton in. Actually, from when this right here, you start seeing this big drop right here. That was literally around the time that we put Trump in office the first time. They were trying to tighten up, back out of it, but then they had to pump into it. And they pumped a ton into it during COVID to get the economy started again. They kept pumping. Well, if they get back to this point equilibrium and they go above that, start dropping the rates, what's going to happen to the price of the houses? That's what you need to think about. Because if you're right now sitting, it's like, Richard Duncan says they may do quantitative easing. Aaron Chapman says they may do quantitative easing. The whole world's screaming they need to do quantitative easing, but I think it's a freaking mistake. But if they do, what's going to happen? You're going to have people buying houses like mad. And you're going to wish you bought now. Because if you're not buying now, you're waiting on something that may or may not happen. And if it does, the price of houses are going through the roof. If interest rates drop 1%, the price of the houses go up by 12%. Think about that. People are going to end up prepaying for the lower rate. You get that. You will get that value. And what we've seen in the past is when the prices go up, they don't really come back down. So you better get in on it now, because if you don't, you're going to be left holding it, and you better call us and let's talk it through. Let's get you set up properly. If you don't have your entity set up right, if you haven't considered a trust, if you haven't done holding companies and all that stuff, we need to talk. You need to get on the phone with me so we can talk this out. I've got ways for you to do this. They'll save you a pile and get you set up properly so you can be ready for this run. Because if the run comes, it's going to come hard, and you're going to wish you had these assets now. All right, guys, appreciate you. I'll get you as much information as I can on Friday.